The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Well, you just mentioned change. Well, change is hard for most people. Whether or not we're dealing with the market, it's hard to get out of the mentality that typically surrounds us or that we have just simply grown accustomed to. And one of the things that the financial services industry promotes is not changing. It is buy and hold, make a commitment, close your eyes, and just weather the storm. And it basically assumes two things. One, as Perry's covered the 10-year period, one, you don't need your money for 10 years. We do. That's the financial services industry. And two, the returns that are promoted as investing, as a result of investing over longer periods of time, don't apply to you because they're predicated on you having all of the money you are ever going to invest invested at that one starting point. And that's not reality. Reality is we have periods of time in our life where we accumulate money and we set aside money to invest, and each one of those has a different starting point, some of which will be very profitable over a 10-year period, and some of which we're not going to be happy with. I had a discussion with someone recently about averages. I said, you look at averages, but they don't apply to you because that's not the way we actually invest money. In this chart, we're basically looking at monthly savings here because savings in the economy as a result of economic activity generates our GDP. Savings now is a reduction in that, but it's savings for the future. In this case, this is a blue line. It may be hard, it may look more black, but it's a blue line. And it shows the savings from the beginning of 2017 through February of 2020. And the dotted blue line right here shows that if we had continued the prior trend, where savings would be today. However, pandemic-related fiscal support in 2020 combined with the reduction in household spending, because we were told not to go out, led to a dramatic increase in household savings across the entire economy. In April of 2020, for instance, we had an unprecedented 32% of household income was saved rather than spent. That was a real change. If pre-pandemic trends held, savings should have been around 106 billion. Instead, it was 498 billion, almost 5 times larger than the trend, and it was basically due to massive stimulus. From March of 2020 to August of 21, personal savings soared above the pre-pandemic level, adding more than $2 trillion in excess savings. So that's what this green line is all about. So we had very strong consumer balance sheets. And as the economy began to rebound, households started tapping into these excess savings to fuel spending. I mean, we saw home improvement, do-it-yourself projects just massively expand. There wasn't enough production of automobiles, and the shortage of automobiles became a problem as prices rose. But by late 21, monthly household savings fell back to pre-pandemic level, but hasn't come back. I mean, we've been continuing to spend money. The consumption can be categorized basically into two primary segments, that's services and goods. So during the pandemic, we were buying goods because we couldn't get services as a general rule. Historically, however, services have constituted an increasing portion of total consumption, rising from 45% in the 60s to nearly 70% by 2020. The onset of lockdowns drastically impacted the service sector, prompting a shift towards goods consumption, because we could order that stuff online and delivery services were still working. This was a significant shift. From January 2020 to March of 2021, consumption of goods grew by nearly 20%, while services over the same period fell by a little less than 1%. This shift increased the proportion of goods from 31% of the total consumption to over 35% by the end of 21. As the economy began to reopen and services became more accessible through 2021, this trend started to reverse. And over the past 3 years, services consumption rebounded strongly, increasing by almost 30%, where goods consumption saw a modest rise of less than 15. Consequently, by March of this year, the share of goods consumption has resumed its downward trend and is now sitting a little above 30%, while services consumption, this is going out to eat, taking trips, hotels, recreational, movies, concerts, and so on, is back to 67% of consumption. Now, adding up all the monthly accumulation of excess savings since the onset of the pandemic shows a peak of little over $2 trillion in August of 21. So with the economy reopening and consumption increasing significantly, consumers started saving below pre-pandemic levels. It's kind of like, we may not be able to do this again. You only live once, YOLO. We did a webinar or podcast on that recently. So, but consumption showed once again that actual saving for the month continues on this below pre-pandemic trend. And the problem moving forward, there's no more excess savings to offset the negative trend that is in process. March was the first month where $2 trillion in excess savings was finally completely absorbed by the lower saving trend. So the problem that we face right now is a consumption growth continuing to outpace income growth, with excess savings exhausted and saving well below pre-pandemic levels. Moving forward doesn't look like a real rosy picture. Now, and this is finally starting to show up here with the, let's just say it's a kind of from an economic standpoint, it's been a long predicted consumer pullback. The markets have been just confused because we've expected consumption to slow, and yet it has not. And it's finally starting to show up particularly in the discretionary areas. The consumer staples, you go to the grocery store because you need food and you need staples, toothpaste, paper towels and toilet paper and soap and so on. But what we saw here in this most recent and current earnings season is Starbucks announced a really big surprise drop in same store sales in its last quarter. And on Wednesday, the shares were down 17% on a single day. So going to Starbucks is a discretionary expenditure. And they reported that their special coffees that they generate to attract business weren't selling, and neither were some of their more expensive food products. At the same time, Pizza Hut and KFC reported shrinking same-store sales. And McDonald's, which is usually a stalwart, has adopted a street fighting mentality, competing for value-minded diners. We have had some work done in our house lately because we had basement flooded back in November. But one of the workers here brought his young son, and they were talking about having gone to a game over in Seattle and buying a hamburger. And the son said, "You can't believe it. It was $18 for a Big Mac." Well, that puts a lot of normal activity. Taking the kids out to lunch at McDonald's and the play games, play store is just out of the budget for some people. This is a problem for ongoing economic growth. Here we have what's happened with sectors over this last quarter. And the only sector that actually had net gains was utilities. The rest of these, here's energy and consumer staples, industrials. Here's consumer discretionary. There's the Starbucks and McDonald's and KFC. I mean, that's all eating out. When it's cheaper to eat at home and the budget's under pressure, that's exactly what is going to happen, despite the fact that the grocery store is much more expensive. So where are we with regard to the market? There are things that recur in the market. Some of them are short-term, some medium, and some long-term, and we refer to this as seasonality. And this is a primary study that's been done in markets for a long time, that every year and every 10 years, there are certain cycles that go through the market. And seasonality suggests that there is support for stocks in the first few days of May. And that's exactly where we are. But then between now and October, and especially through the middle of the month, we basically have a market, and you've probably heard before, sell in May and go away. That doesn't always work, but we don't trade on it, but we're sensitive to saying we need to have some support for where we are to suggest that whatever market exposure we have is justifiable. The risk makes sense instead of blindly just walking through whatever happens. But the window for a rebound here does appear to be narrowing on a seasonality standpoint. One of the offsets is that in presidential years, presidential election years, seasonality is often not as negative as it is in non-election years. So here's where we are now, and that we have, this is April right up through here. We broke this trend line, and this dotted line is a 20-day moving average. And that's basically been support for the market. And even through Friday, this has become resistance. We need to be able to break through this. There's a 50-day moving average. We need to break through that. And the fact that we break through it for a day does not mean it's going to hold. It means it's a test to see whether or not there are enough frustrated owners of stocks who may have gotten in late and said, I'm even, I'm going to sell. That's generates supply. And so we need to see this actually trend down, break up, trend down, break up a couple of different times. I have another chart here I think is going to show up that shows that pattern. But here's where we are with the basic levels of support in the market. And right now we have near-term bearish conditions. We go out in longer-term points. Intermediate is generally positive. And if you're a long-term buy and hold investor, which probably means you're not on this webinar, then you don't care where prices are right now because you're in here for the next 10 or 20 years before you're going to need the money. Whether we look at the NASDAQ or the S&P that we just looked at or the NASDAQ, the picture is basically very, very similar as far as the technical conditions of the market. This was the high of the intraday high of the market, and we've put a red line in here that basically is a level of resistance, and it matches the 50-day moving average. And this is just simply looking for enough buying activity to move the price up. One of the things that's happened with Chairman Powell's speech this last week on Wednesday was that he said they're not cutting rates anytime soon. Well, if you don't cut rates, then the cost of interest for business and unfortunately for government and households remains high, and higher interest expense means there's less discretionary income. So we are in a trading range that requires more buyer input. One of the shorter term indicators is in this lower panel. When this red line is on top, it basically says the odds of moving upward are not in your favor. So we have very little exposure, which would be indirect, into the NASDAQ technology area at the present time. It may rally, but what it's done is it's rallied and it's hit these resistance levels and it's fallen back. We need it to rally, break through, fall back, break through, fall back, break through, and then probably get back to the all-time high, where it will go through the same kind of testing pattern to see if there's enough support, enough buyers coming into the market who are afraid of having missed out. Now that's FOMO, fear of missing out, and they become buyers and will push the market upward. Now, one of the things that has been exciting the market and drove technology in the first quarter of the year has been artificial intelligence. Now, this is really changing the way the economy works. This little guy here is a creation of artificial intelligence. We found an article online with a young woman who's an animator, a professional animator, and she's worked in the industry for the last 25 years, mostly for corporate clients, capitalizing on her talent for colorful illustration, movement, figuring out what her customers want, but don't know how to articulate. Recently, because of the advent of AI, artificial intelligence, and its ability to generate movies, short-term movies, she basically has been freaking about her life's work. I mean, she's been in this for 25 years and she had several big expenses on the horizon, and yet her workflow from about a dozen annual projects dwindled to 3 so far this year. More of the clients and creative agencies that she used to work with are trying to do animation work themselves with AI. But what AI can't do is tell you, oh, it's a really stupid idea. We have a marketing agency. We've talked with them recently, and we were told, we don't think that works. You can do it if you want to, but it's not our recommendation. AI is not going to tell you that. AI is just simply going to say, this is what you want done. If it's stupid, that's your problem. We're going to do what you tell us to do. So there's some recognition of this coming into the business, and while it's going to impact where labor, as we've known it, is actually retained, it's going to create new opportunities for labor in other areas, but we don't quite know where all those areas are just yet. So when we look at the NASDAQ, when we look at trend, the near to intermediate term remains bearish because the excitement of AI being all things to all people, improving all life, just isn't real. And we're going through this period of facing reality. This is going to change our lives, but we don't know exactly how it is, and it's a little uncomfortable. And when we look at the small cap area, where smaller companies are more adaptive, they don't have big overhead, they don't have large legacy issues. We've always done it that way. Why are we changing? To overcome, they can bring new product, new ideas into the marketplace faster. But even here with the smaller companies, the Russell 2000, we have a lot of this choppiness that's going on. We're really in the middle of a trading range. This chart goes back to, this shows January. This is the beginning of the year here, and we've been above it, and we've given up the yearly gains and the year-to-date gains, and we're right back up at testing some of these higher resistance levels. And the question is, it's frequently, is small cap ready to soar? I mean, 3 ETFs to play a potential massive rebound in small cap stocks. That's a pretty much a headline that is promoting investing in small caps because they're still cheaper than the really expensive AI stuff. But again, we look at the lower panel and this red line that basically tells us the underlying trend here remains negative. You should at least be cautious with what you're doing. Another headline is that small cap stocks endure sharp losses in April, the worst performance in months, according to Jefferies, which is a brokerage firm in the Midwest. So that's not particularly encouraging after all the promotional advantages that occurred through here. And yet, if we take a longer term view of this, what we find is that this chart goes all the way back to the fall of 22. And we really haven't gone anywhere with small cap stocks. What we've had is a lot of chop. We see things and the value proposition is promoted by the media of value stocks are cheap. This is where the bargains are. This is where your future wealth is. They get a quick rally right up to resistance and they fall. They rally to resistance, they fall. Rally, fall, rally, fall, rally, fall, rally, fall. We're right in the middle of a 2-year span of going nowhere with small cap stocks, which actually has from November 5th, which is up here, to the 3rd, it's a negative compound 8% return. That's not what you think you're buying when you buy into the stock market, but if you're long-term buy and hold, modern portfolio theory, that's what you get. You allocate a part of your portfolio to the small cap stocks and say small caps outperform large caps over long periods of time. The word that's missing is very. Small caps outperform large caps over very long-term periods of time. So we just simply don't believe that you should own small caps all the time when they're not giving you what you expected. So when we look at the market, there's always components of the market. How's the market behaving? That's basically a function of investor behavior. What are investors doing in the market and how do we track that? There's different kinds of data that we use to do that, some of which are short to intermediate terms, some are which if you're a long-term buy and hold, 10, 20 years before I need my money, then those factors are different. The short-term factors are irrelevant to you. Currently, what's happened is that the volatility of the market has dropped in the last couple of weeks. That's a benefit. It means fear is subsiding. And the market breadth is the number of companies that have moved from falling to rising chart patterns. That's a positive. On the longer term, stocks are still better than being in bonds. And the price trend for the S&P, even though I just showed you that it has been correcting over the last 6 weeks, if you are a 10 or 20-year investor, that trend is still up. Intermediate and short term, what we're looking is that it's been falling for 6 weeks and we don't know where the bottom is. The same is true for the NASDAQ. The internals of the market remain negative and the cumulative volume is low. It's below average. We showed you this chart last month, and I update this. I update it every day, but we publish it in our 401k updates twice a month. So this was actually mid-month. This is the middle of April, and everything was negative. Then the volatility factor improved. It started falling. People became less fearful. When we finished the week here, we basically had improvement in volume. Particularly Friday was a very high volume day. And actually the day before was pretty decent, and breadth continues to improve. But this basically leaves us in a neutral position. Where are we going to get the next benefit? Are we going to get investors deciding that they have missed out and they start dumping money in high yield bonds? Are they going to become less fearful about high interest rates and credit problems, particularly in the commercial real estate area? Rate of change of the S&P, will that improve from the decline of the last 6 weeks? And all of things are unknown. The other issue with all of these is that these can flip-flop overnight. So it requires a little more time to verify that the changes are going to hold. And if they don't hold, then our entire process is adapt to the new reality. We're not going to hold our nose, close our eyes, and say, in the end, it'll all be all right.